Let's talk about the S&P 500. As you know, I am in the S&P 500, 100% of my portfolio. One, I think it's the best asset you can own at the moment. Two, most importantly, it was done for the benefit of the show. I interview CEOs, want to be seen to be impartial, want to be able to talk to them unbiased, without prejudice. I also want to not to be seen as a channel that is pumping and dumping stocks. I've never have done, but now I demonstrate it with my real money, and I only own the S&P. Also, because I've now made my target of $100,000, and now I'm aiming for 150 within 12 months and $1 million within 6 years, I'm on target to achieve that with just the S&P. So I know my goals, know my targets, and I can achieve my goals without the drama, the stress. So another reason why I'm in the S&P. But I'm not alone here in my thought process, and I'm going to share some news with you why you might consider joining me perhaps and being in the S&P. 4 charts show Fundstrat call for the S&P to triple. I have said this, and I said this before I read this. You may remember last week I said I believe by the end of the decade the S&P 500 could triple. I gave my reasons for it because the way the 493 stocks, take away the top 7, have been sitting around. I want to be fully clear. There's actually 505 shares in the S&P 500. Always a bit weird that. But anyway, there are many stocks. The majority of the stocks are moving, but they haven't had the explosion that the top 7 have had already. Plus, we are in an industrial revolution once again. We have AI, problem-solving stocks. We have electric cars, flying taxis, going into space, landing on Mars. All of these things are massive catalysts, which only happen a few times in history. We are at that period. So I've done my calculations, and I am in with margin, as you know, $30,000, because I believe that there's so much potential growth without the stress, without the drama, without the risk, really, with hardly any risk whatsoever, hence why I'm in margin. And I've expressed my thoughts why I believe the S&P will triple by the end of the decade. It typically doubles every 7 years anyway. So this isn't a million miles away from what it normally does, but this is better. However, this year we've seen a real growth. You've seen my portfolio grow. Fantastic. However, it's again normal. When people look at it, they go, it's had a great year, but on average, it works out normal because the next few years might go sideways for a while. So what we're experiencing now isn't that unusual. Over the period, it's normal. But anyway, I've expressed these views already. You've heard my thoughts, why I believe the market is going to triple. Now let's hear from someone who perhaps watched my show and thought, I agree with Martyn. I'm going to come up with this. This has just come out, but I've been saying this now for a few weeks. So let's see what this gentleman has to say. This is Fundstrat's Tom Lee expects the S&P to top 15,000 by 2030. That's exactly what I'm saying, have been saying now for a few weeks. Demographic trends, millennial spending habits, and technology advancements will be key drivers. I agree with that. Here are the 4 charts that show why Lee is so bullish on the stock market. Fundstrat's Tom Lee raised eyebrows last month when he made an extremely bullish prediction. The S&P 500 will triple by 2030. Need to be clear, lots of these people that come on to CNBC, I've watched, I've studied, I've made mistakes with them, are pundits. They are, when I say pundits, I don't mean that in a negative term. They are people that have an opinion, that get paid to share their opinions on TV. And it's very dramatic. People will say, buy something, it's great, sell something because it's rubbish, whatever. It's designed specifically, great contributions to their channel is great for the viewers. The number one thing is to get people to watch and share content from CNBC. I've been caught out many times on claims that this is great, you should buy it and whatever. And 9 times out of 10, there's a lot of truth in it. However, timing is everything for your initial reaction. I believe time in the market, time in is the most important, not timing. However, as a human, if you react to the news story and buy in, chances are over the next couple of weeks you'll be down and go, well, that was rubbish. That is what tends to happen. But remember, the news item was there to get you to watch and react and so on. It's not financial advice aimed at you. I believe you should already be in the S&P. It's already up some sort of 30% over the last 12 months or so. You've seen my portfolio. So chasing it today, it might not be the best thing for you, and depends on your tolerance and your understanding and how much money have you got and what are you risking and so on. So just bear that in mind. Even though this is a very bullish statement, it is designed, even though it's factual from his point of view, it's flavored, and its purpose is to entertain and get you to watch. So you need to understand that. Doesn't mean it's right or wrong, but you just need to understand the color of it. In an interview with Bloomberg's Odd Lots, Lee said he expects the S&P 500 to top 15,000 by the end of the decade. The index traded at around 5,630 on Friday. I agree. If this is a normal S&P cycle following demographics, S&P should be potentially 15,000 by the end of the decade. To me, as you move into a longer time frame, that's probably where I think we're moving towards, Lee said. In the interview, Lee said he was looking at a handful of charts that back up his bullish long-term prediction. When I made my prediction that this was the case, I wasn't looking at charts. I was looking at people's sentiment, problem-solving stocks, the way the world is pivoting and changing. That's what I was looking at. I'm glad to see he can see it on a chart point of view. Sensei would appreciate that, but that's not what I'm looking at. I'm not looking at what charts are telling me. They only told me what we did last time. Are we likely to do it this time? I'm not looking at that. But it's nice to see he has, and he's drawn the same conclusion. In the interview, Lee said he was looking at a handful of charts. Oh, I've just said that. I apologize. Here are the 4 charts Lee shared with Business Insider that show why the already upbeat forecast is so bullish on the stock market. All right. Thank you, millennials. Lee put the chart above together several years ago. But his thesis, I'm just going to carry on reading for a moment. His thesis remains the same. The average age of millennials is now around 31 years old, and the global cohort of 2.5 billion people is starting to enter its prime age years of 30 to 50 years old. And at this age is where people start to really think about the S&P. He's right there. This would be the 3rd time that stocks entered a cycle where annual returns compound at high teens. You had the roaring 20s, then you had the 50s through the late 60s, and this is the 3rd cycle, Lee told CNBC last month. They all coincide with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults at this time is powered by millennials and Gen Z. It's a demand story. When you get to your prime years, 30 to 50, urban institutes show you start to borrow more money. You're making big life decisions. This is what powers the economy. I agree. At a time when we've got the explosion of all the technologies I've already spoke about. Stock market peaks and demographics. You can pause the video and take a look at that chart if you want to. The stock market has a history of peaking right around the same time a population hits its peak prime age of around 50 years old, as they are closer to retirement and often spend less money. For example, when the greatest generation peaked in 1930, that coincided with a multi-year bear market in the stocks. Fast forward to 1974, when the silent generation saw its prime age peak, this occurred around the same time as a painful stock market correction of about 35% that lasted years. Now, before we move on, let's talk about that. If you are like me and you are buying the S&P and you're using margin, we are now at the beginning of this growth. Nvidia is just starting. Tesla is just starting. All of these things are just starting. We've got a few years ahead. Yes, there may be a short-term correction, but we're already up 30-odd% over the last sort of 12 months or so. If we end up pulling back 20%, that would be a big drop. However, that would present another opportunity for people to start doing it again. I would still be up 10%, and then it will go up and beat where it is today. So I'm not worried. Very famously, Warren Buffett was asked, what does it feel like to lose millions today? And he said, I didn't lose millions. I just stayed in the stock. I just stayed in. I would have only lost if I'd sold. If we do get a 20% correction now, it won't affect me as a margin call because I've got a 65% buffer, so it won't bother me whatsoever. It'll allow me to buy more, knowing that I still believe in the economy, or the markets rather, the economy and markets are separate, still believe in the S&P, the index, the businesses that provide the services and the goods and so on. And it will just allow me to buy more, maybe take my margin to 50,000 and we'll get another bounce back. It won't concern me whatsoever. It will just present more opportunity for the long-term picture. So anyway, moving on, that's important to talk about at this point, a potential correction. Doesn't change the basic principle. At the peak in the baby boomer population's prime age was in 1999, just a year before a multi-year bear market hit stocks. Remember, if we get a run of a run of a bear market, things are sort of going sideways for a couple of years, or it's not, the stocks aren't growing. That's when I start just keep paying off the margin and just keep increasing my balance, because as I pay off the margin, my balance goes up and I'm not borrowing any more money. There's no point. I bought when it dipped before it rallied. If we pull back and go sideways, I'm not buying anymore. I'm just paying off the margin, but I was able to buy the stocks at the lower price 6 months ago, a year ago. And I don't mind a 3-year low. 3 years would be fine. Imagine how much money I could pay off all the margin and then sort of mass up some cash, earning interest, ready for the next run up. Be great, right? Anyway, the average millennial is not set to hit their peak prime age until 2038, suggesting plenty of upside ahead for the stock market between now and then. 2038. Tech will address a global labor shortage. A lot of people think that high tech is bad for the economy, as in it will put people out of work. It'll create new jobs. If we're going to put man and woman, if you like, on Mars, we've got to build hundreds, if not thousands, of rockets and things like Starship. Well, there's not enough human beings on the planet to build all the rockets, is there? We could have millions of Optimus Prime. We've got some Optimus running around. I don't mean Transformers, but Tesla's Elon Musk Optimus running around building all the rockets. There's not enough people to do it, but it will create new jobs where people are needed. So it's a whole new economy. According to Lee, spending on technology will boom in the coming years as the world grapples with a growing labor shortage. I agree. We have a really big opportunity for US technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So there's two forces are combining to, I think, power all to power AI, to power all. Is that AI? To power our AI most, that's a typo, I think there, most a decade of extraordinary good stock returns, Lee said. I think that there's going to be a lot of dollars spent on US technology product because the world is short 80 million workers by the end of this decade. Elon Musk has spoke about this a lot. There's not enough people on the planet. People say, oh, there's too many people. Elon Musk is saying there isn't. This has been discussed many times. There's not enough educated professional people to do the jobs already. So we're not putting people out of business. There's plenty of work to be done. 80 million workers by the end of this decade. That's roughly 3 trillion of labor salary that's turning into silicon. So that means US suppliers of silicon and AI are going to have a 3 trillion revenue run rate. Makes sense. Money will flow into US tech stocks. And of course, the S&P is the best way to buy that. You might like the NASDAQ, which is more tech-based, but of course, then you've got the risks of when it peaks. And there are other businesses that will do well because of it as well, those that supply the industry. Hence why, for me, it's the S&P. As more companies spend trillions of dollars on technology to address a global labor shortage, that will catapult the technology sector to make up 50% of the S&P 500. Oh, imagine that. The information technology sector currently makes up about 30% of the index. If US companies are growing earnings at this speed, the PE multiple of the US should go up. There's going to be capital flows into the US. Where else in the world do you find the best and most important technology companies? They're all basically in America, Lee said. I think he's absolutely right. I think that's the end of the story there. Yes, it is. So what do you make of that? If I come back to my S&P, my actual portfolio, let me do my face recognition. You'll see there is my portfolio. As you can see, the growth on the S&P this year has been absolutely fantastic. I am, of course, beating the market, as you know. If you look at my positions, I am beating the market because I am in margin, so that's increasing it. I've got $30,000 worth of margin, so you can see I strongly believe I'm putting my money where my mouth is. I started with $5,000. I've never shorted a stock. I've never done options. I'm not even trading. I'm still staying in. And there it is, 105,370. We get a pullback, slow down, doesn't matter. I don't need to buy any more. I'm all in. I'm now spending the next 6 to 12 months paying off my margin, depending on what I can earn on YouTube. Just keep paying it down, paying it down. If we get a dip, I'll buy more. As it rallies again, I'll just continue paying it down again. That's simple as that. As long as I keep myself a very strong buffer, which I have, and there's no need to get greedy, no need to go crazy. You can see there, I have got a 65% buffer. It's actually costing me, if you scroll here, look, $5.26 a day in interest. That's what it's costing me a day, and the rates are going to come down, so it's going to get less. And you can see today, just on my brokerage account, I'm up $393. So today it's cost me, 5+. Doesn't matter, does it? I'm 65% or in fact more than that. That's just the margin buffer. 100,000. That is actually my money. 105 grand. Margin is not put on top of that. There's 30,000 worth of stocks that are in, but that's what that's my cash. That's what I'm worth right there. So, I've got $105,000 working for me. That isn't paying interest. That's all profit, 100% as it rises. I'm only paying the 6.5% interest, which is the $5.66 on the 30,000. So it's all relative. It's all balance and whatever. But it makes sense for me to pay that money to maximize the benefit of this. But now we're going up again. All I'm doing is focusing on paying it down. I'm not chasing it up. I just buy more when it dips and reassess the new levels. Anyway, there we go. More information on the S&P and stuff like that. Click above my head, down below in the description. Over here and over here, I'll put more stuff for you. If you want to tap the like button and consider subscribing, that would be absolutely great. All right, so check out the videos. I'll put my Alpha Spread playlist and another playlist I think you'll find useful. All the links are below. Until next time, take care of yourselves and each other.